the delivery means. So let's say you're trading commodities. And if it's something that you're interested in, like you want to trade corn, wheat, oil, cattle, hog, you can trade all these different commodities that we've got. And essentially, those get physically delivered. So, for instance, you get into one of those contracts and you trade a commodity, and each one of those has an expiration a month out. Each month has a new expiration date. If you don't close your position and you get exercise in that position, they can literally they will deliver cattle to your house. They will deliver bushels of wheat or bushels of corn to your house. They will deliver barrels of oil to your house. That is a physical delivery. If you close that position before you get exercised, that will get settled monetarily. It will be financially settled. Okay. I don't want you guys to get afraid that you will get barrels of crude oil delivered to your house, because your brokerage is going to let you know before that happens, hey, you've got a position. Do you want to roll it or do you want it physically delivered? The reason why they have physical delivery is because there's different market participants that use futures for many different reasons. Futures are basically for people that, at least the commodities, are for people that are trying to hedge their stock, or not stock, but I meant livestock, trying to hedge their asset, their commodity, because the price fluctuation that happens at market. So let's say, for instance, I'm a farmer and I grow corn, and there's a company that makes corn syrup, and that company that makes corn syrup wants to lock in a specific price on corn before the price of corn increases, which then hurts their bottom line. The producer of corn syrup would hurt their bottom line. They would have to increase price of their corn syrup, or they would have to do layoffs, or they would have to find some sort of way to make up the cost of that corn that they're going to have to buy. So they would want to lock in corn at a lower price, so that when price of corn increases, they're already locked in at a particular price, and they can then plan for that. That in turn would hurt the farmer. The farmer would then lose that money, that difference that they would make. So you have those two different market participants. Then you have speculators like ourselves, like retail traders will speculate on price based off of what we think the movement is going to be. Or in our case as straters, we're using price action to tell us where price is going to go, based off of our triggers and based off of our price targets, spotting formations, all those wonderful things that the strat gives you. We're speculating on price, and we're just trying to get in and get out what we can when price fluctuates. Okay, so those are the reasons why other people trade futures as well. You have institutions as well, that like banks and stuff like that will hedge their positions as well on longer term portfolios and things like that. They'll use futures to kind of balance their portfolio out.